investment strategy, and you lead that at Emkay. How are you playing the market at this point?
Yeah, so the biggest variable currently is oil. And, the ceasefire, which was supposed to result in a diplomatic settlement, has not yet fully played out, even as we speak. So, the problem is that we have seen $125 on the crude. Currently, we are hovering at around 116. So, till about 125 gets hit, broadly, we have seen the negatives as far as Indian markets are concerned. Now, what happens is that if these sort of embargoes still remain in West Asia, then, we'll see oil, the inventories, because, the production capacity has got whittled down significantly due to the war. And the cushion is basically the inventories which are there. Now, the inventories are going to reach stressed levels in the month of June. Now, if that happens, then it's going to be a big spike in oil prices. Probably the world markets are not yet prepared for. So that is the moving part currently. Nothing else matters. The markets could swing either way based on whether we see a settlement on a diplomatic basis or we see a settlement on a military basis. So from that point of view, I think markets will be very range bound in the near term, maybe between 22,000 and 25,000. Difficult for the markets to cross 25,000 in a hurry till about the resolution of the West Asian crisis.
Manish, given the fact that I think Q1 would be a washout because the crisis doesn't seem to end, at least till May end. In that scenario, how do you think earnings are going to be reworked or estimates going to be reworked? What is the kind of growth you are penciling in for FY27?
Yeah, so 20% of the companies basically have come out with numbers, and this is data as of 1st of May. At least for the fourth quarter, there have been beats more than misses this far. 50% of the companies which have reported, and those which we track, have reported numbers and are beating the estimates, and 25% of the companies are missing the estimate. As we speak, and if this embargo doesn't end very soon, then obviously FY27 numbers is going to be, cut. Because this inflation shock, the rate increase, the working capital, the supply chain disruption will mean that there is going to be stress on the balance sheets of companies. And obviously the growth which is currently being built by us at around 13%, 12 to 13%, will see further downside if oil price goes to spike. So, as in the first week of May, as we look into FY27, we still believe that 11, 12% is doable. But this can change very rapidly on the negative side if this whole war doesn't end quite soon.
If that is a scenario, what is the kind of valuation that you are looking for the Nifty at least? Do you think that current valuation of 18, 19 times will be there and it's going to be a difficult task for FIs to come back and invest at this valuation?
The Indian markets are currently trading at around 19.5 times FY27 numbers. So we can't say it is exactly very, very cheap. For a 10 to 12% sort of earnings growth, then 18p is more than enough. So I think the floor comes at around 18p, and that will be coinciding with levels of around 22,000. That's basically the floor. And we have seen 22,000 get tested quite a few times, Operation Sindoor and the first round of shock. On the West Asian crisis, we also saw defending of 22,000. So currently also we believe 22,000 acts as a floor. Currently it can break on the downside if oil prices was to spike $125 and beyond on the Brent side. So as far as the FI flows are concerned, I will not really build in any expectation of FI flows into the near future in India, probably because of the reasons already known. The currency is depreciating big time. We are running overshooting risk on the current account deficit before India, and we'll have to lean on the support of the SIP flows and our domestic mutual funds to have a cushioning impact as far as the downside of the Indian markets is concerned. Only if we have some tinkering on the capital gains front positively for the foreign institutional investors, or we have some semblance of sanity and resemblance of fair values on the Indian currency, or let's say we see macros in India get reset, particularly by raising fuel prices, etc., so as to not stress the government balance sheet, then probably we'll see some further buying by FIs. But currently, the base case scenarios don't build in a positive flows in the near future.
So, Manish, you're looking at a possible negative impact of crude coming in. You're seeing FIs looking at other geographies as probably more attractive geographies to invest in. Does the sentiment therefore look far weaker? And at the end of the day, markets are a slave of earnings. So if I were to shift focus towards earnings, is there a significant risk to FY27 earnings as a result of crude? And if so, how much are you building in?
Yeah, so it could, Nifty 50 earnings could come down to single-digit earnings. The near-term risk to earnings is very, very big if this whole resolution doesn't happen within the next 2 to 3 months. If by the end of the first quarter we are not seeing any resolution, then jolly well we could build in high crude oil prices, and that will not be great for earnings as far as India is concerned. But coming to the point, I think it's all about bottom-up stock picking, and certain sectors will stand out because in this West Asian crisis, India's vulnerability on the energy security front has got exposed very badly, and we should basically prepare ourselves for such shocks like the closure of the Strait of Hormuz, etc., going into the future as well. And so power, energy, anything to do with the power value chain, energy, critical minerals, or let's say the AI infrastructure build, which is globally the big theme, these are sectors which are likely to do well. On the earnings front, and the BFSI space has really seen credit pick up as we step into the month of May. 16.5% sort of credit growth is what we are building in for the whole of fiscal 27, which is higher than the last year. And there is no credit stress currently in the financial system, whether on the NBFC side or the banking side, corporate or retail. That's a very good thing. And so the financial system is in fine shape. The manufacturing sector will see some stress. Of course, certain sectors will stand out, like your semiconductor space or your mobile EMS. These are some of the sectors will be favored, not the regular sectors of the sectors which we have been used to following.
Financial services, what is it that your tilt or preferences towards?
Banks and insurance, both on the health insurance as well as the general insurance, particularly leaning on the health side, and even the banking system, the entire pack, you have to pick and choose between the private sector banks and the public sector bank. There are enough takes, even the NBFCs. You're leaning heavily on the power value chain, the critical minerals, which is basically a commodities. We are leaning on, the chemical space. Certain specialty chemicals companies are going to benefit tremendously because of the crisis in the West Asia. Certain companies are not going to be so benefited. As it is, the specialty chemicals play is coming off a very low base. So there are picks and choose in the specialty chemical space. The capital market space is oblivious. We just saw, BSC report higher market share in derivatives turnover than NSE. And the March quarter was not at all impacted on the capital market space as far as whatever numbers have come out from the AMCs, etc. So that is again one space which looks quite good. CDMO restocking selectively is happening in the global value chain. So again, that sector has seen a lot of correction. I will be slightly mindful of over-owned sectors, the transformer space, or some of these high-flying names. Everybody seems to be buying all these things. So valuations are a big hygiene check that one needs to do, but these are some of the spaces which look interesting from a stock picking perspective on account of low valuations, decent earnings growth, and under ownership.
Okay, Manish, I can extend this conversation, but I'm stretched for time, so I'm going to try and come back to you at some point of time in the next few weeks to try and get a perspective. It's so fast evolving, and your views really matter, I'm sure, to viewers. So we will call you back. Thank you so much, though, for coming in and